Every CEO's journey has its Everest. The moments when the path forward feels steep, uncertain, and alone. With Sherpa CEO coaching, you don't climb alone. Our experienced coaches are your guides, helping you break through barriers, sharpen your strategy, strengthen your leadership, and build a team that can carry you higher. With tailored one-on-one coaching, strategic planning, and real accountability, your summit is within reach. Sherpa CEO Coaching, your guide to confidence, clarity, and extraordinary business growth. Get coached and learn more at sherpaceo.com.
Welcome to the Entrepreneurial Journey with your host, Dave Westcott. The Entrepreneurial Journey is a weekly podcast that streams live every Tuesday at 9:15 a.m. Pacific on Dave's YouTube channel and LinkedIn profile. Now here's Dave with this week's episode.
Good morning and welcome to the Entrepreneurial Journey. I'm your host, Dave Westcott, and I have with me this morning special guest, Jacob Vanderslice, co-founder and principal of VanWest Partners. Jacob, good morning.
Good morning. Thanks for having us on.
Yeah, I'm super glad that you're here. I see in your background you got a little drawing from the kids or something like that in the right-hand corner. Is that from the kids over there?
Well, the big painting off to my right is actually, you've got kid stuff on the desk, and the big painting my grandpa painted back in 1980. He kind of played around with Western art. Yeah. That's an airplane propeller. So lots of weird stuff going on in my background here.
I like the little thing over on your, I think, left. It looks like a little circle with some little drawings on it. Look like kid did it.
Yeah, I got two boys that are 6 and 7. They keep us busy.
You know, that's my favorite part. I got some kids too. I got an 11-year-old and a 9-year-old and a 3-year-old, and you do
have some kids.
Yes. I do. I've started collecting them. I don't know if it's good or bad or if I'm going the wrong way, but I love getting up, and sometimes in the morning I'll get up to my little sink there and they'll have put a little thing out and it'll say, "Dad, I love you." And I say, man, that's the reason for the day. I love it.
Makes it all worth it. Makes the grind worth it. Agreed.
It's very, very true. So you were a firefighter at one point. That's kind of where everything started out. Is that right? You were a firefighter, arson investigator.
It's ancient history. I mean, it's been almost, I think it's been like 19 years. And it was a lot of fun and had a bunch of time on my hands. You only worked 10 days a month. And I started dabbling in real estate, mainly residential fix and flips, and liked real estate. And I wanted to be an entrepreneur. So I quit my job and been gainfully unemployed, I guess, since maybe it's been 20 years now, actually, since 2006. I forgot it's 2026. And we started off doing a lot of residential deals, mainly in Denver, but all over the country. Did a joint venture with some institutional capital when the big money entered the SFR space back in 13 and 14. Then we got into commercial real estate around the same time. We did some adaptive reuse retail projects around Denver. We did some townhome developments, some multifamily, and we got into self-storage in 2015. And at the time, it wasn't really a strategic pivot into a new asset class. It was more just, hey, let's try a deal out and see how it goes. And it went okay, so we did some more, and over time we evolved into being pretty much exclusively a self-storage owner-operator. We've got a handful of non-storage assets, but that's most of our platform.
Is it accurate that you still run about 1,000 residential properties in that portfolio, or have you sold that off?
We've done. Regrettably, we've sold. We sold 98% of those, and the rearview mirror is always crystal clear, right? Had we had the discipline to hang on to more of those, it'd be a different story. But, different era. We were recycling capital, generating cash versus generating wealth. And one of the reasons we shifted to self-storage is we wanted to kind of adjust our thesis on real estate investing to being more medium to long-term holders versus being transactional, right? Buying, making better, and selling over and over again. But no longer own the vast majority of those. I wish it was a different story.
Yeah, that some of those home prices have really shot up, haven't they?
Yeah, it's definitely moderating, as we all know, but the home price appreciation that we've seen in this country has just been absolutely astounding, especially in certain markets. Who knew, right?
You're right. If hindsight is always 2020. Yeah,
Yep.
I love it. So you guys are in this self-storage space. What is it that drew you to your very first acquisition of a self-storage piece of property?
Well, we jumped in the deep end head first, and our first project was actually a pretty sizable development project here in central Denver. And we didn't know what we didn't know. And we overshot our rents and our underwriting. We thought it would lease up faster than it did. A lot of new supply came online at the same time that we were building ours. They were just risk factors we didn't appreciate. So we kind of got to know the business like everything else we've done in our careers by screwing up. And the deal had some bumps in the road, but eventually it had a positive outcome when we sold it back in 2022. But we liked a few things about it. We liked the durability of the asset class. It's been historically fairly downside protected. Our fundamental demand driver is really American mobility. So whether people are moving for good or bad reasons, whether the economy is expanding or contracting, generally dislocation events, both good and bad, drive our consumer demand. So we like the fact that it's been historically resilient. We also like the granularity of the revenue streams. We're relying on thousands of customers to pay us $30 to $300 a month, depending on the unit type. And we're not beholden to one large, triple net industrial user, or office is easy to disparage, one large, 40,000 foot office tenant, and you leave them, or they leave your space, and it takes you a couple years and $1 million in tenant improvement allowance and leasing commissions to find a new one. And we also like the dynamic revenue management. All the leases are month to month, so we can respond real time to supply and demand changes at the unit level, the facility level. We can drop rents, we can raise rents depending on how different unit types are performing. Those are the good aspects of it. And I would say the main risks of the asset class, outside of your normal real estate risks like cap rates, interest rates, general demographics, your main risk is supply. It's very much a 3-mile business, and your main risk is the introduction of maybe unappreciated new competition that could drive down your rents and occupancies. So the grass isn't always greener in self-storage. It's still a resilient asset class, but supply is definitely the main kind of sensitive lever in our analysis and underwriting.
I understand. So number one, you find this. So just let me make sure I got this right. Property number one, you found a piece of land. You said, "Hey, this looks good for us." You developed this self-storage unit. You built it from the ground up. You paved it, built the buildings, put it in, put the gates, all that. You looked at something that you modeled off her, and you put this together, and that was number one. Was from you design and build number one. Is that correct?
That was number one. Yep.
And what made you go that route versus saying, "Oh, here's one that's for sale. Let me just pick this up and ease my way into it"? What was the decision-making process that said, "Let's build one" versus "Let's buy one"?
We came across this site, and it was mostly entitled and designed already. And another self-storage developer took a pass on it. We had a relationship with them, and a fair amount of the design and entitlement heavy lifting was already done. And It's in our backyard. And our investors and partners on it have a long development history, mainly in multifamily and industrial. They weren't afraid to build, and we weren't either. So that's why we went that route on the first one. We've done 56 storage facilities. We currently own 41. And very few of those 56 we've done were actual development projects. And that's kind of outside the norm. Most of our deals we've done over the years have been existing facilities. And the reason for that is development is risky, right? It takes a long time. It's a long path to revenue. Sometimes it makes sense. But of our current 41 assets under ownership, we've only built 2 of those.
Oh, wow.
So we don't build too often, but our first deal happened to be a development project.
Yeah, that's cool. I mean, it's nice to build it. I guess you got that experience under your belt, and then you could decide whether you wanted to continue doing that or you wanted to just purchase. And it sounds like you purchased. So now you've got 41 of these units. Are these all Central Rockies, West Coast, Midwest? Where are these located? Are they centrally located? Are they spread out? How did you decide on the geography?
Yeah, we're fairly geographically diverse. So we're in 15 different states. We only have 4 in Colorado, and we wish we had more, but it's a competitive market. It's hard to find arbitrage. We have a lot in the upper Midwest. We've done a bunch of deals in the Milwaukee area. We've sold most of those. We currently own one in Milwaukee that we're going to be converting from industrial to self storage. We own one in Green Bay. We have a fair amount in the Carolinas, Central Florida, Florida Panhandle, and a little bit in the Southwest. Our furthest facility west, we have one kind of standalone deal in the Inland Empire of California. But aside from that, we kind of stop just east of the Rockies, Cheyenne, Front Range of Colorado. We have one in Tucson, and everything else is east.
Okay, so you are all over the place. I love it. When you look at the facility and you look at managing and you look at the cost on that, being in 15 different states, 41 units, you got things like mowing grass and plowing snow and paving parking lots and fixing leaks and repairing gates and all of these things that run into it. Do you find that being spread out like that, do you lose cost on that, or do you find if you were tighter together you'd save more, or how do you go about managing the actual facility at this point being so spread out?
Well, one common misconception about self-storage is that it's not necessarily easy, but less difficult, right? If you have a 700 unit storage facility, you probably only have 2 bathrooms and a break room versus 700 plus bathrooms in an apartment building, right?
Right.
So people often think it's a little bit easier to run, and every asset class has its challenges, but I guarantee you right now, somewhere we've got someone breaking into one of our units. We've got a U-Haul backing into a gate system. We got somebody probably cooking meth or storing drugs. We've got 21,000 units. So bad stuff happens all the time, especially in our more kind of infill locations. But management in real estate is obviously very challenging, and storage is no different. And we self-manage our entire portfolio. And when people ask kind of why you self-manage, my response is we suck at it less than everybody else does. and the reason we suck less at management is not because we're necessarily smarter or because we have a better technology platform or we're better than the REITs. That's not the case. We just pay a lot more attention because we're owners, and we're fighting over that $1,000 HVAC invoice. We're rebidding snow removal and landscaping contracts. But operations is, especially in this more difficult environment the last couple of years, I think our ops team has been the main reason we've been moderately successful, because we control that operational outcome of our portfolio versus sourcing it to a third party. As far as our structure goes and how we do it, so we have some deals that are clustered together in various markets. Like we have a number of deals kind of within an hour of Charlotte, North Carolina.
Okay.
But we have one deal that's off on its own in Columbus, Ohio. We don't have anything else nearby and nothing else in Ohio. So if we buy something, we intend to add more to it, but if we can't, that deal needs to stand on its own from an operating expense perspective, from a management team perspective. Culture is really important in our operating company, which is called Clear Home Self Storage. Our kind of investor facing brand is VanWest, but our property management company is Clear Home. And we spend a lot of time engaging our employees all over the country on Zoom calls and on team meetings. We go out and see them. So even though we're all fairly spread out, it's still fairly tightly knit. And that's important when you're all trying to accomplish the same objectives.
Yeah, that's cool. So let me make sure I understand it. So you've got, these properties all over the place, but if you have something like Columbus, Ohio, that's still your manager. That's your W-2 employee who's in that building. And is that person responsible for the landscaping and the snow removal and the HVAC, or is that handled at the national level where your procurement is vetting and driving costs down? How do you break that out?
Yeah, we have a number of national vendors that we use, and we have different national contracts for, like you mentioned, HVAC maintenance, landscaping, snow removal. The role of our on-site, I mean, they'll pick up trash from the parking lot, they'll clean up the leasing office themselves, they'll clean the bathroom. Our on-site manager's role is kind of the GM of the property. So if we're doing anything that's fairly sizable, like repairs and maintenance, we're coordinating those repairs from our Denver office, but our on-site is still running point, kind of with boots on the ground for those. So we empower them as much as we possibly can to make the right decisions for the property because we can get pictures of it, but our team from Denver is not there all the time. Obviously, we're there frequently, but we're relying on their eyes and ears to go manage vendors, subcontractors, and more importantly, our customer base.
Yeah, that's awesome. Well, it sounds like you guys are doing a great job. You got 41 units now. What are the plans for growth? What does the next 5 years look like?
Yeah, deal flow has been extremely challenging. And if we find a deal that we love that meets or exceeds our risk adjusted return requirements, we'll buy it. But those have been fewer and further between in the last, call it, year or 18 months than they've ever been. In 2024, for example, we bought 7 deals, and after buying those 7 deals, we had to look at 900 and financially model about 250 for 7 acquisitions. In 2025, which is obviously just behind us, we only bought 1 deal. And we have an acquisitions team. We have a great broker network that bring us deals. And 1 deal for 25 is kind of a testament to how tight the market is and just how much uncertainty is out there. So as far as growth plans go, we don't have a specific AUM target. We're in the low 300 million range right now with our 41 properties. A lot of entrepreneurs will say, I want to get to whatever, 500 million or $1 billion in AUM. And I'll tell you from a depth of experience, bigger is not always better. We just want to buy quality deals. And if a quality deal does not show up, we're not buying deals. So growth wise, we'll grow organically based on what the market is bearing. But we don't have a target of whatever X millions in AUM by a certain date because the market's just not there right now to scale in a responsible manner. That's going to change at some point, but not today.
Yeah, I love that. You don't want to do what Wendy's is doing right now and shuttering 300 stores or whatever.
Man, I mean, total digression, but somebody opened up a brand new Wendy's near my house, like full build out. I mean, new construction. That thing was dark 6 months later. I can't imagine how much they put into that space and just to close it down. So
probably a couple million bucks.
Yeah, probably.
There's actually, I live in a small town with 16,000 people, and they just opened a Wendy's like 2 months ago.
Well,
we'll see
hopefully
how
they
it
can
does.
capture more market share than competing with all the other QSR concepts in a major MSA. Right?
Well, Wendy's, there was an article just came out. Wendy's just lost 300 million, right, in 2025, I think. So
I missed that. Wow.
They're shutting.
Too bad Dave
stores
Thomas
down.
isn't around anymore. He'd be riding that ship quick. Right?
That's right. That's right. As leadership changes, so does the life of the initiative. So does the life of the business.
Yes, it does.
But back to this deal. So you got a full acquisitions team. You do 1 deal in 2025. How many deals did you look at in 2025?
Those 24 numbers are fresh on my head, and I need to figure out what our 25 numbers were. I suspect we did not look at nearly as many as we did in 24, but it still has to be hundreds and hundreds.
Right.
And generally on the deal flow front, about 70% of our acquisitions have been sourced off market, and that's a term I don't use loosely. Off market can mean a lot of different things to a lot of different folks. When we say off market, it came direct from a seller or direct from a broker relationship just to us. On the other 30% of the deals we bought in our storage careers, those were marketed, but often kind of inefficiently marketed, or we had an inside track with the relationship somehow. If it's a deal that's nationally marketed by a big brokerage outfit like a Marcus and Millichap or a JLL, We typically, even in this kind of touch and go environment, we cannot compete. These things will trade for just irrational pricing. There's a lot of shops out there with more money than we have, with a lower return threshold and a lower cost of capital. And despite the fact deal flow is down, when deals do hit, it's still hyper competitive as far as what the market's paying. So I'll have to check on that 2025 funnel, but
it's still
it's
still in the hundreds. It's still in. I mean, you're still looking at a lot of property.
And the narrowest funnel probably in a year at the bottom ever with one. I don't think we have done one deal in our self-storage careers in the last 10 years in a given calendar year, but that's okay.
You know what? It's better to grow safe and slow than to blow yourself up. I'm a believer in that. But you talked about you went through this process and you basically cash flowed, or you put financial models together for 250 deals. You got 7 of them. When you put together that, what is the process that you're going through to put that financial package together? Is that looking at the aggregate of all of the money that unit brings in, the cost of management, the cost of maintenance, the cost of deferred maintenance, and then you're saying this is our profitability that we're shooting for? Is that basically what you're doing?
Yeah, we're. I guess first of all of our financial models are wrong, right? The model never goes. The deal never goes like the model says it will, and we're making assumptions on financial metrics that are years down the road, right? Net operating income, cap rates, rents, and all you can do is make a reasonable assumption that's conservative and then try to execute on that plan. But if we're targeting a 15.2% IRR on a given deal, I can almost guarantee it's not going to be the return. But as far as the stuff we look at specifically, there's a lot of different metrics that go into it. But the first thing we look at, as I mentioned a few minutes ago, is supply. And supply in self-storage is expressed in square feet per capita. And that's called a supply ratio. So nationally, there's about 7 or 8 feet per capita. And you might infer in a given market that's over that, it's oversupplied, or under is undersupplied. That's not necessarily true. What we're mainly looking at is where historic supply has been and where occupancies have been. Some markets have storage facilities that are all pretty full, and they might be 20 feet per capita. So the first thing we're looking at is where are rents, where are supplies, and where are occupancies. And then secondly, we're looking at subjectively and objectively, what is the risk of new supply being introduced to this submarket anytime soon? We're looking at zoning. We're looking at concept reviews with the city, building permits. We're trying to gauge what the risk is of somebody building nearby anytime soon. And we can't totally prevent against public storage building a bomber, 2 years from now, a mile away from us, but we want to understand that risk as best we can. Beyond supply, the next thing we're looking at are in-place rents on that given facility and market rents. And obviously what we're looking for is a dislocation there. We're looking for deals that have some element of inefficiency. The operator's got below market rents, above market expense loads. They may not have a website. They may not be marketing very well. They may not have ancillary revenue streams like late fees, tenant insurance, U-Haul truck rentals. So as we're extrapolating out our revenue in a given 5-year hold period, we want to see a good growth opportunity to bring customers up to market. And how do we do that? Well, we take an empty unit and we put a customer in that empty unit through marketing. We also will strategically increase rates on below market customers. And then third, we'll layer in ancillary income streams, which I just described a minute ago.
Right.
And whether you're a self-storage investor, operator, multifamily, industrial, I would say all real estate entrepreneurs, private equity shops have a common singular goal, and that is growing net operating income. In real estate finance, NOI is not unlike EBITDA in traditional lines of business. And commercial real estate trades on a multiple of the net operating income the deal produces, otherwise known as a cap rate. So tiny increases in net operating income, depending on the cap rate valuation of the deal, small increases in NOI can equate to exponential increases in the value of the project. So we're trying to grow NOI. How do we do that? We do it on the top line with the ways I described a moment ago. But the bottom line is just as expensive, or important, I should say. We're trying to control our variable costs, our fixed costs. We're trying to run these things as lean as we can. And the gap between that expense load and the revenue that's coming into the deal is NOI, and we're trying to grow NOI.
You seem very intelligent with the numbers. Like you're very smart with the numbers and the statistics. It's almost like you're doing a very, very detailed, much deeper detailed SWOT analysis every time you're putting this thing basically in place, right? Like you mentioned a lot of things there. You're looking at rents, occupancies, threats, potential threats. You're looking at the amount of people that live in a specific neighborhood that are going to potentially buy. What's the cost of marketing? What's the cost of infrastructure? You're putting all of these things together, and then you're saying, is this a good deal for us? And even after all that work, it still doesn't follow the plan that you've put in place. And so you're still working out kinks and gaps and that sort of thing as you continue to grow. And the goal is one thing: growing NOI to build the best business that you possibly can. What happens when a public storage comes into market?
Well, on that first development project that I mentioned at the beginning of our conversation here in Denver, again, we didn't appreciate the impact that new supply has. And the market was set up in a way where a lot of developers had the same idea at the same time, us included. And a bunch of us delivered around the same time. So what happened in that first year or two of operations is our leasing had a lot of downward pressure because of competition. And our rents, we weren't able to achieve our rents that we wanted to in our model the first couple of years of operations. And it's a supply and demand issue, right? A bunch of self-storage units come online at the same time. Everyone's fighting for the same customer pool. So the $100 unit goes to $50, right? And move-in concessions increase. And it's a race to the bottom to try to buy up your physical occupancy. But inevitably what happens after that pain, if you can survive that pain, what happens is the market will shift back again. It's like a pendulum, right? It'll shift over to being oversupplied, rents, occupancies go down, and then developers stop building because the fundamentals have evaporated. It doesn't make sense to go take the development risk anymore because rents have gone down. Everybody pulls back, and then inevitably it takes a while. Those new facilities start to fill up, rents stabilize, and the pendulum shifts over to being undersupplied, and developers jump back in the game. And we've seen it all over the country. You know, the cycle periods kind of vary from market to market. Again, it's a 3-mile business, but it hurts for a while. And the question is always, can you hang on? And the way you hang on is with conservative, prudent leverage and as long of a debt maturity as you can possibly have. I want to say all, but most of the pain in private real estate the last couple of years has been debt related, right? Floating rate loans. Yep. Operators have a loan maturity and they can't refinance with a new loan that's the same or higher than their old loan. They have to capital call, or they have to fire sell it because their bank is putting them in technical default or even normal default because they're not making their payment. Debt is a beautiful and terrifying thing. And debt will increase your deal returns because obviously the denominator for the equity is lower if you're bringing leverage to the table, but debt also exponentially increases your risk. So you've got to find a happy median there on your leverage. Too high is bad, too low is inefficient on your equity, and you got to find a good blend.
There's so much that goes into looking at these deals. You know, I've looked at a handful of these public storage, or not public storage is the wrong word, but these storage unit type deals. And similarly, I've never been able to find one that I actually thought penciled. Like you go out, you look at this thing, it might have a bunch of units in it, but by the time you look at the money in the thing, it's like it's profitable if you're there, living there, managing it, watching it, putting in a U-Haul, you know, doing all of these extra things that, you know, bring ancillary income. And so I can understand where it's like, man, you really got to do your due diligence on these. You really got to be on point. And I know people who have got out of business, selling their business or thinking they're moving on to the next business to get into storage and have actually killed all their wealth and killed everything they built and have gone back to what they were doing before because they got into storage units that they thought was going to be the greatest thing since sliced bread, and it ended up being a bullet to the head. So
Yeah.
the diligence that you put into this deal is really impressive, and I think it's a testament to greatness to only do one deal in a year, because that also takes discipline. I mean, as a company that's wanting to grow, every company wants to grow, right? You don't grow, you die. Everybody wants to grow. Everybody has targets and goals, but to say, listen, this is our financial model, this is our plan of business. No matter what, we're going to hold to these guidelines, and if that means we do one deal or no deals or whatever, we're still paying our team, we're still growing our business, we're still taking care of our responsibilities, but we're going to be strong enough, we're going to be disciplined enough to say, hey, we're not going to make this happen, is a huge testament to your business. And I think it's absolutely fantastic. What is it on your team? I mean, you're a principal, you're a co-founder, obviously you've got partners and, different people on your leadership team. But when you're sitting around, where did you learn this discipline? Where did you grab it? And how does your team navigate through these challenges and not compromise? Because I think when companies compromise, that's the beginning of the end. They don't see it, but that's the beginning of the end. But what is it that gave you that discipline and that ability to deliver business at such a high level?
Yeah. On the question about how do we learn this, the simple answer is failure. It's failure. The home run deals we've had over the years, we didn't learn much from those, and no doubt there was an element of operational excellence and execution that helped deliver good returns on those. But sometimes you just don't know why it went so well. The deals that haven't gone well are what we think about constantly. And every year we're really excited for 26. We're 2 weeks in now, because every year we get less stupid. So we're a little bit less stupid than we were a couple of weeks ago, which is hopefully going to be great for our business. But when we're looking at a new acquisition opportunity, we'll strap in with the leadership team, our operations team in the conference room, and we're getting buy-in from everybody who's going to be responsible for executing this business plan, right? Our property management team, our asset manager, our controller, and we're throwing darts at the assumptions in the model, and through osmosis and debate, going back and forth on whether we can hit those assumptions in the model, right? Okay, and this given acquisition here, we think we can push rents by 15 or 20% by the end of month 18. Tell us how we can do that. Well, the ops team comes in and says, well, I don't know, we've got a deal a few miles away that, we're not achieving that on, but it's also older construction with a suboptimal unit mix. It's a lot of debate, but we have never and will never buy an acquisition that we don't all unanimously agree is a good acquisition. And obviously it comes down to the return target that we're trying to achieve. We're trying to solve to a really good story to not lose money primarily, right? Like on this given deal with this leverage and all these assumptions, how do we lose on this deal? And, no matter what you do, you can always lose, right? You can figure out how to lose somehow. But we want to see the narrowest path to failure possible. Things have to be pretty nuclear to have this deal not work out. And then secondly, we're looking at the upside on it. So we want very muted downside, and we seek quantifiable and achievable upside. And then we go off and buy it and execute and see how wrong we were, 5 or 10 years later.
I love the deal analysis. I love how you're sitting around the table. I can just picture it. You got this deal. It's coming up. You're looking at the property. Can we raise rents? No. Can't we? You're not going to be able to get there. Can we manage it? Like, you're really batting this thing around before you pull a decision on that. And I would imagine that, that's a great business practice for all businesses, not just in real estate. I mean, there is clients, I don't care if you're in construction or the fruit smoothie stand business, that are just going to be an absolute nightmare, and you need to say, go away from me now, right? But because we want to chase the dollar, we're like, okay, it always ends up bad, right? And then there's that great business that we all want to get. And so the closer that you get to it, the better you roll down that path. I guess if we went back 20 years, what would you do different, if anything?
Yeah, that's a tough one because sometimes you can really rabbit hole that, and you get depressed and your energy goes away and you just sit there and so, I'm going to go sit in my truck for a bit and take a nap, right? If there's one specific thing, and not necessarily a specific thing, but I would not have sold as much as we've sold. You talked about discipline earlier, and I appreciate the kind words. How little do you know, my friend? But it takes discipline to not, buy everything that shows up. It takes discipline not to just gunch the rents in your model and suddenly make it a deal. But I would also say it takes more discipline to not sell than it does to sell. We raise a lot of capital from private investors. We have some family offices and some institutional investors, but when a kind of a retail investor comes in, they'll fill out a web form and then we'll schedule a call. We'll get on Zoom and we'll kind of tell them about us. And I get on this call a couple of years ago, and this guy, not that I'm ageist necessarily, but this guy sounded really old on the phone, right? Mm-hmm. And I'm kind of, I don't know if, I'm not sure if I want to tie up this guy's money for 5 or 10 years, right? And then we start talking, and I was like, do you have any real estate experience? And he's like, yeah, I own about 60 million worth of commercial real estate, my wife and I. And I was like, oh, okay. Well, that's wow. He's like, yeah, I just built it up over the years. And then he asked me one of the simplest, most kind of compelling questions I've ever had in real estate. And then actually he made a statement. He asked me the question, when do you guys plan on selling these? And I was like, well, sir, 5-7 year hold, this and that. And he's like, the problem with selling, right? And I was like, what's that? And he tells me, you don't own it anymore. And I just sat there in silence for like 5 seconds. And I was like, gosh, if you sell it, you don't own it anymore. And I think about that constantly. And there's a time and a place to sell. And I'm not saying we're holding indefinitely, but when you sell, you kill the cash flow, you pay taxes, and it's over. And you have to go find somewhere else to redeploy that capital. And especially in this environment, that's very difficult. And so many of the wealthy real estate owner operators that I've met over the years, their thesis has been, I buy stuff and I never sell it. I know some people have owned deals for 50 years. They bought it when they were 25 and they're 75 now, and they've accumulated along the way. And going back to your discipline comment, it takes discipline to not force deals on the acquisition front, but I think it takes more discipline to not sell and just strap in. And inevitably, the value of that property and the cash flow is going to increase over time. And I would look back in the last 20 years and wish we would have held on to more than we did. Yeah, that'd be the one regret.
That's it. That's a great insight. That's a great insight. So, just in talking to you, I mean, you've definitely been on the entrepreneurial journey. You've definitely had the ups and the downs. You've definitely, I mean, I can tell you've fought through the tough moments. The ride hasn't always just been, easy, right? Like business ownership, entrepreneurship, tough.
Yeah, I mean, I started residential real estate in 2006, and obviously we all remember 2008. Baptism by fire. And I think about those days constantly and how hopefully we're positioning ourselves in our position that if another 2008 happens, we've got a sound balance sheet and a portfolio that's going to be able to sustain itself.
I mean, I think the bonus is everybody's always got something they've got to put somewhere, because we accumulate so much stuff that you just, you got to go put it somewhere. You know what I mean? I think of a storage unit I have down in Texas that cost me $400 a month. It probably cost me more to keep the stuff in the unit than the stuff is even worth at this point, right? At $4,800 a year.
Dude, I can't, that is our typical customer, and just indulge me and I'll try to make this story as succinct as possible. We own our office building in Denver. We had a bunch of vacant space downstairs, and I was keeping like family heirloom furniture. I had like 12 pairs of old skis, camping gear, mountain bikes, like stuff I don't want in my house, I don't want to get rid of. And we put a tenant down there, so I had to put it in the storage unit. And unfortunately, it's a storage facility we don't own, but it's like 2 blocks from the office, so it was easy. So I put my stuff in there in a 10x20. And I was like, couple months tops in here. I'm going to give away stuff to Goodwill. I'm going to bring stuff to my sisters. 18 months later, my rent had doubled. And it was enough to annoy me, but not enough to turn my lights out and make me take action. Finally, one day I was like, all right, I'm making the time to do this. I'm getting rid of this stuff. I'm moving it elsewhere. I'm bringing it home, giving it away. But to your point, I probably spent thousands of dollars to store, $1,000 worth of stuff, right? It's out of sight, out of mind. And that is the avatar of our typical self-storage customer. It's out of sight, out of mind. They don't want to deal with it. We send them a notice. We're taking them from $85 a month to $105 a month. It's not enough for them to take action, to call up a buddy on the weekend and rent a truck and move it somewhere else. Most of our customers who move out because they no longer need the unit, not because of the rate increase. And it's just one of those things, the American psyche. I don't want to deal with it, and it's not enough of a monthly nut to affect my income that much. And that is our ideal customer, right? Just like you with your units in Texas.
That's right, man. I hate it. I bought a house. I was going to move into it. I ended up not moving into it. I furnished it. What was I going to do with all the furnishings?
Yep. And someday you're going to take care of the stuff in that unit, but that day is not today.
It's not today, and it's not tomorrow, but it's on my mind. It's at least once a month. It's on my mind. I got to do something.
Yeah, it hits that Amex, and you're like, damn it, I got to do something about
that. That's right.
And move on, and here you are. Yep.
That's right, man. All right. So what's the number one lesson that you've learned in 20 years of entrepreneurship? What's number one on the list?
Man, downside protection. My wife and my partners always get annoyed because I'm always just the downside guy, the Debbie Downer. How do we lose? What's the downside? But downside protection simply means kind of what I described a moment ago. And it's subjective, and it's hard to put a finer point on this necessarily. But if you're going to go out and do a deal, tell yourself a story that's almost impossible or very difficult to lose money. And the second thing I've learned, I think, also is take a risk and take action. If you're sitting on the sidelines looking to deploy capital into a private syndication or fund, or maybe you've been going to classes about buying a rental property, you're not going to learn anything unless you're doing a deal. And doing a deal involves taking a risk. And the best education I've had in real estate finance over my career, I was a history major or atmospheric science minor. I didn't study finance, and that hurt me for a long time just because I didn't understand it, right? But I get it now just by failure and doing this full time. But you don't learn it unless you're taking action and taking risk. So protect the downside. There's no perfect deal. There's no completely aligned risk-adjusted return on a given deal, but take action and take a risk. And that's how you'll learn and grow wealth over time. The way you won't do it is sitting and reading books and going to classes and never applying that knowledge to making an investment in real estate.
Man, I love that. That's great advice. That's great advice. So people invest with VanWest partners, right? So instead of taking that risk and going out and buying their own public storage unit or their own storage unit or whatever it is, they're not going out and do that. They're not buying multifamily. They're not buying a strip mall. They can invest with you. You hold their money, 5, 7, 10 years till you sell it, till it pays off, whatever. But they're able to get some return on investment from that, right? That's basically what that happens. Probably takes a couple of years to turn, but then once that turns into a profitability standpoint, they're getting 10%, 8%, 12%, whatever back every single year in a cash dividend, and then when they sell, they get a payout. Is that basically how it works?
Yeah. Whether it's us or somebody else, there are countless private real estate operators out there that raise investor capital for single asset deals and for funds. And it always should be a component, I think. Obviously I'm biased here, but it should be a component of your wealth creation strategy. Having private real estate exposure, it's a way for you to get an allocation to an asset class. To your point, you're probably not going to go out and buy your own apartment building or buy your own storage facility. That's the opposite of passive, right? But if you find good operators who have a good track record and a fair structure, That's a something you should consider to kind of diversify your portfolio. Private real estate's been beat up the last couple of years for a bunch of obvious reasons, but over the long run, it's performed fairly well. So
Yeah, it'll
you can go
turn.
out and
It
do it
always
yourself.
does.
It does, yeah. But
It
can you
always
hang on,
turns. That's
right?
right. That's
And
right.
you hang on with debt management. Yeah.
The thing I like about what you do, I think, is that, you're putting the money in, but you're not responsible for the management. You're not responsible for all the due diligence. You're just kind of letting your money ride. Are you going to let your money ride in the stock market? Are you going to let your money ride in some real estate? Are you going to go buy a fruit smoothie stand? I don't know what you're going to do with it, but you got to do something with it. And it seems to me that if I was going to do a deal, if I was going to put money somewhere, I'd want to put money with the guys who did one deal in 2025 because they were so diligent that they killed hundreds of other deals. I mean, it seems like that's the guy that I would want to work with if I was doing deals, if I was looking to, you know, uh, stabilize my portfolio, if I was looking to build wealth, if I was looking to do any of those things, I would want to put my money with somebody who's not just making crazy decisions. How does somebody work with you? Like if somebody's listening to this call today and they're like, man, these guys seem smart. These guys are on point. I want to be in this. I want to tell people that I'm a storage unit owner. I should stop saying public. I don't know why I keep doing that. And I apologize, but I'm a
That's like,
storage
it's like
unit
chicken
owner.
McNuggets or chicken nuggets, right?
That's
It's like
right.
everyone call it. Yeah, yeah. They've done a good job inventing the business.
That's right. And
Well, folks can they can reach out. They can go to our website, vanwestpartners.com. They can email me, Jacob at vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice. Whether you want to invest or not, we always love to talk shop about real estate. And we spend a lot of time educating potential investors, not necessarily on our platform, but just on things to ask a sponsor, things to ask an investment manager, right? And a lot of folks ask the wrong questions. The question they'll ask is, well, how much money can he make me? What's my return going to be? And the question they should be asking is, tell me about your worst deals, what the outcome was, how you handled those. And then on this deal that you're trying to pitch me on, tell me about how I lose money. Tell me about my downside. Um, a lot of investors who even have deployed a fair amount of capital into a variety of different platforms. Sometimes they're guilty of just not asking the right questions. Don't tell me about your successes. Tell me about your failures. I don't care about your successes.
I love that. It's very transparent of you. Most people don't want to do that. I think I like you more now. Um, when you're doing one of these deals, who is an ideal investor? What are you guys looking for on your side?
Yeah, we've got just over 450 investors, and we've got anybody from CEOs of publicly traded companies that are worth hundreds of millions of dollars to institutional investment companies to folks with a $25,000 self-directed IRA who just wants to get a little bit of exposure. So it really runs the gamut. The one common theme between all of them, all of our offerings require that you have to be accredited. And accreditation simply means you make $200,000 a year if you're single, or you make $300,000 a year if you're married, or your net worth is $1 million or higher outside of your primary residence. If you meet either the income qualification or the net worth qualification, you're accredited. So that's the only kind of investor avatar rule that we have, and that's an SEC thing. So you have to be accredited.
Okay.
But beyond that, we've got entrepreneurs, we've got big W-2 Apple employees, like I said, CEOs of publicly traded companies. Kind of the cross section of our investors is pretty wide.
Man, I love what you guys are doing. What a great business you guys are running. And I know you're going to say, Dave, you're only seeing it from your side. I know, because you're a humble guy. You're going to say, Dave, you don't see the misses. But you know what? I really have just enjoyed just learning from you and just talking about, everything that you've done to build this, and, and what you're seeing and what you're looking at. I guess I've got just a couple of questions before we get done here. But I guess as we kind of bring this thing in for a closing, a couple questions. What are some of the most important trends you're seeing in real estate today, and what should investors be looking for?
Yeah. You always got a 50-50 on forward-looking statements. And with the rate that interest rates were increasing, I thought that we were going to see a calamity in 23, right? Sitting here January 23, it's going to be a bloodbath. Office got beat up. There was some multifamily pain, but, relatively wasn't that bad. Same thing with 24, same thing with 25, right? Here we are in 26. There's pain, but it's not, meltdown pain. As far as the trends we're seeing in real estate, we can kind of use a couple different asset class examples. Office has obviously been majorly under distress, right? There's buildings in Denver that have traded for 15% of what they sold for pre-2020, right? So watch out for office. Multifamily seen a lot of distress. Multifamily is kind of the biggest, it's probably the biggest real estate asset class in the country as far as investment real estate goes. There's been a lot of pain in multifamily. Cap rates have gone up, values have gone down. A lot of that's been because of debt issues. Self-storage has been kind of stuck in neutral to a degree. Consumer demand is not what it was, I would say, back in 22, early 23. And the reason for that, I think, is people are not moving as often as they used to because they don't want to pay off their 3% mortgage and borrow at a 6.5%. So they're redoing the kitchen. They're doing an addition. They're not trading homes like they used to be. And that mobility is definitely creates some downward pressure on storage. But trends, you've got macro trends and you've got micro trends. And we're much more focused on the micro. What is happening within, 20 minutes of our development project we opened up in Southeast Denver? There are always opportunities, good markets and bad. But I would say 2026 is a time for not fear, but certainly caution. I think there's always uncertainty about the future, but the future feels more opaque than it's ever been, right? Interest rates, what's going to happen with the economy, the stock market's way up, what's going to be the shoe that drops. So just watch for the fundamentals. And if you're considering an investment, get to know the operator very well, understand their history, because whether you maybe overtly know this or not, you're to a degree investing in the team more than you are their asset class and their strategy.
Absolutely.
Because when things don't go well, the people on the team are going to be the ones who hopefully are going to step up and see it through.
Absolutely.
But yeah, the trends are, data centers are, a hot topic, obviously. How much more runways does AI boom have? You can't build enough data centers. But a lot of not only retail capital, but institutional capital, I would say the theme they've had the last year or so has been reluctance to deploy. Very reluctant to make investments. And that's part of the reason I think the market transaction volume has been lower than normal. Yeah.
That's great advice. That's great. All right, I've got one final question. We've got a big billboard on the side of the road. You can put one sentence on it, one word, one topic, one phrase. What would you share with the world?
Take a risk. Take a risk.
Love it. I love it. Take a risk. I love that one. That's phenomenal. Well,
it's so easy to get soft in your job, and you've been thinking about taking a risk and doing something, but oh gosh, I like my paycheck. Nothing wrong with a W-2. Believe me, there's many years I've wished I've had one. But a lot of people just get soft and think things are good enough, and maybe they are good enough for you. But taking a risk is how you create wealth and opportunity. So take a risk.
Well, I can tell you, I've never had one. So at the end of the day, at some point, your back is always against the wall, and you never feel more alive than when your back is against the wall and you're making decisions to fight for your life. You never feel more alive.
Yeah. If you haven't been forced to put your payroll, that cycle, on a credit card at some point in your entrepreneurial career to feed your team, you haven't gone through it yet. Yep.
It'll get you one way or the other. Man, this has been an awesome show. I've really enjoyed chatting with you. Thank you so much for the time that you've spent. This has been the Entrepreneurial Journey. This has been a fantastic show. We are back 9:15 a.m. Pacific Standard Time every single week, having fun, learning, growing, build, measure, learn. We're doing that whole thing. If you like this show, give us a like, give us a share, drop your comments into the comment box. My man, this has been an awesome show. Thank you so much for everything that you've shared. It's just been fantastic learning from you today. Thank you so much for your time.
Thanks for having us on, Dave. It's been a blast.
Thank you.
Every CEO's journey has its Everest. The moments when the path forward feels steep, uncertain, and alone. With Sherpa CEO coaching, you don't climb alone. Our experienced coaches are your guides, helping you break through barriers, sharpen your strategy, strengthen your leadership, and build a team that can carry you higher. With tailored one-on-one coaching, strategic planning, and real accountability, your summit is within reach. Sherpa CEO Coaching, your guide to confidence, clarity, and extraordinary business growth. Get coached and learn more at sherpaceo.com.